The world is strange. One day you are here, one day you are not. One day you buy your first Alibaba share and think you have forever free shipping as an owner of the company. And the other day, you realize it has dual class stock and what you own is not that important. Now let's see. What are dual class stocks and why do they matter? Imagine you found a company. It's a great one. You generate such cash flow that it seems you have the Fed printer working for you. Pretty impressive. But you calculate you'll need external capital to grow massively. Now you face a dilemma. You acquire debt to finance your needs, or you raise capital by selling shares in the stock market. The first option will add street to your balance sheet, and there will always be the possibility you go bankrupt in case you can't pay what you owe. The second option seems way better. You'll be able to raise capital when your stock is overvalued and buy back when it's undervalued. But there is a tiny problem. If you aren't careful, you could lose control over your company if another party buys enough stock in the public markets or from other shareholders, and you will go from owner to employee. Tick tock, tick tock. Time goes on, and you need to satisfy your capital needs now. Look, up in the sky. It's a bird. It's a plane. It's Super Dual Stockman. Sorry, Super Dual Stock. Now, what is so special about this structure? If you decide to use it, you can issue two different kinds of stock. For example, Class A can be issued for the public and would have only economic rights. That is the right to perceive economic benefits derived from your company's activity. Class B can be issued only for the management team and selected people and would have economic and voting rights. That is the power to make relevant decisions on the company's strategy. This is the benefit of dual class stocks. You are able to raise capital issuing Class A shares without sacrificing control and by keeping Class B shares for yourself. This might look like a phenomenon going on in recent times in the corporate world, but it is an old practice coming from the youth of the 20th century. Way before titans as Amazon and Alphabet were born, in a world dominated by big industrial companies, the New York Stock Exchange banned the use of dual-class stocks in 1926 after a controversy with the automotive company Dodge Brothers that issued non-voting shares for the public. This was changed during the 1980s due to the pressure from other stock exchanges that started to accept this kind of practice and created the threat that NYSE could lose its appeal as a market for future IPOs. There are several passive vehicles that stopped, including dual-class structure companies. In today's world, the dual-class stock structure is preferred by tech startups, since they can raise the capital they need without losing control of the company's destiny. One example is Alphabet, whose Class A share is for us, common mortals, and one share represents one vote, while Class B is reserved for founders, and each one has 10 times the amount of votes of one Class A share. Later, the company issued Class C shares with no voting rights. Take a look at it. Let's see Facebook. Here you have Zynga. Here's a few reasons why companies like to use the dual-class stock structure. 1. If the control remains on the owner, founders, and top management, this can help protect the company from short-term pressures, such as focusing on meeting Wall Street's EPS expectations. 2. It allows management to focus on what really matters, healthy long-term growth. 3. Because these kinds of shares are hard to be traded, as they don't list in the stock market, the company has loyal investors. 4. The takeover of an individual wealthy speculator or hedge fund can be blocked, one that is interested on cutting research and development investments or selling the profitable branch in order to cash out rapidly and get out of the company. Let's remember what Carl Icahn did to Trans World Airlines in the 1980s. He paid himself an astonishing amount of $469 million. Then sold the London routes for $445 million, which was its most valuable asset. The company ended up with a debt of $540 million, went bankrupt, and was later acquired by American Airlines. These are the dangers of not having a dual stock structure. However, there are people that criticize this model. Let's see some of their arguments. 1. If the company is not well managed, there is little to be done by outside investors. 2. It's unfair. A small group of shareholders keep the privilege of maintaining control while other shareholders provide the majority of capital, which creates an unequal distribution of risks. 3. it's easier for the management to try a buyout in case the business goes really well and wants to take it private again, which hurts long-term investors who want the company to continue improving in public markets. Love it or hate it, dual-class stock structure is here to stay, and investors must be aware of the consequences of participating in these kinds of ventures. Thank you for watching Simply Finance. Like and subscribe to see more videos.